Welcome to Self-Tax YouTube channel. If you're an expat, business owner, or landlord and you're not subscribed yet, this channel is for you. We break down tax rules, deadlines, and changes clearly and simply. Hit subscribe and stay compliant, without the stress. If you are a landlord in the UK, 2026 could be the year your tax process changes more than you expect. A lot of landlords still think making tax digital is mainly for businesses or sole traders. That is only partly correct. Now, landlords are part of this change, too. In this video, I am going to explain what MTD for landlords means in 2026, who it applies to, what records you need to keep, how quarterly updates fit in, and what rental property owners should start doing now. Yes. From the 6th of April, 2026, landlords will be required to use Making Tax Digital for income tax if their qualifying income from property and/or self-employment is over £50,000. So this is not just a change for sole traders. If you receive rental income and you cross the threshold, MTD can apply to you too. HMRC's current guidance says that from the 6th of April, 2026, sole traders and landlords must use MTD for income tax if their annual income from self-employment and property is over £50,000. The key figure is qualifying income. For landlords, property income counts toward that threshold. And if you also have self-employment income, that can be counted too. This means some landlords may enter MTD not because one property alone is huge, but because their combined qualifying income from property and self-employment takes them over the line. HMRC says qualifying income includes property income and self-employment income. It also says some income types do not count, such as partnership profit shares, but personal property income does count. If you are a landlord who falls within MTD, the main change is not just one more form. The whole process becomes more digital and more regular. You will need to keep digital records of your property income and expenses. You will need compatible software. You will need to send quarterly updates. And then you will still need to complete the final year-end process through software. HMRC says landlords in MTD must use compatible software to keep digital records, send quarterly updates, and complete the final tax return process. Landlords need to keep digital records of their property business income and expenses. That includes things like rent received, maintenance costs, repairs, insurance, agent fees, and other relevant property expenses. The important point is that these records need to be maintained digitally as part of the MTD process. If your records are scattered across paper notes, bank screenshots, and email receipts, that is the kind of setup that will create problems. HMRC's MTD record-keeping guidance says taxpayers must create, store, and correct digital records for income and expenses as part of the system. Quarterly updates are one of the biggest changes landlords need to understand. These are not for full tax returns every year. They are digital summaries based on your income and expenses for the property business, sent through compatible software during the year. That means landlords need to stay much closer to their numbers instead of waiting until the year-end to work everything out. HMRC says quarterly updates are sent from digital records using compatible software and provide ongoing in-year information rather than replacing the full year-end process. This is an area where many landlords get confused. If you jointly let a property, HMRC says you do not need to link your digital records to the records of the other landlord. And HMRC's property manual also says joint letting does not automatically mean a partnership. That is important because some landlords wrongly assume joint ownership creates a totally different tax structure by default. HMRC says that where property is jointly let, one landlord does not need to link their digital records to the other landlord's records. HMRC's property income manual also says joint letting does not, by itself, make the activity a partnership. If you are a landlord who may fall into MTD, waiting until 2026 is a bad idea. Start by checking whether your qualifying income from property and any self-employment is likely to exceed the threshold. Then review how you currently keep records. Then look at MTD-compatible software. And finally, get used to updating your figures regularly rather than treating tax as a once-a-year event. HMRC says landlords who are due to enter MTD should prepare by checking if they are affected, choosing compatible software, and getting ready to keep digital records and send updates. The biggest mistakes landlords are making right now are simple. 1. Assuming MTD is not relevant to them. 2. Not understanding what counts toward qualifying income. 3. Leaving rental records disorganized. 4. Thinking quarterly updates mean for full tax returns. And 5. Assuming they can solve the whole thing at the last minute. That mindset is exactly what creates stress when rules change. HMRC's published guidance and support material for landlords focuses on understanding whether and when they are affected, preparing digital records, signing up correctly, and using compatible software. So, what must landlords do in 2026 under MTD? If your qualifying income takes you into the regime, you need to move to digital records, use compatible software, send quarterly updates, and stay more organized throughout the year. The landlords who prepare early will handle this far better than the ones who ignore it until the last moment. Thanks for watching. Subscribe to Self-Tax for clear practical UK tax guidance. Stay informed, stay compliant, and stay one step ahead of HMRC.